Let's take a look at some FTSE 250 companies that you may want to add to your own dividend portfolio. I'm not a qualified financial advisor, so please do your own extensive research before making any investments. The FTSE 250 is a market index and it's made up of 250, would you believe it, mid-size cap companies, and they're traded on the London Stock Exchange. These companies are not quite big enough to make it on the FTSE 100, but they're still some of the largest publicly traded companies that we have here in the UK. So why do we care as dividend investors about the FTSE 250 when we have the FTSE 100 to look at? Well, it's because this index tends to be a great place to find some of those dividend companies that also have some capital growth potential. And that's because smaller companies tend to, not always, but they tend to grow a lot faster than the larger companies. Just talking about dividend yield, the FTSE 100 comes in at 3.8% and the FTSE 250 comes in at 3.04%. So you can see that as of right now, the FTSE 250 dividend yield is lower than the FTSE 100, but that's not always the case. This always changes. For example, in August just gone, the FTSE 250 dividend yield came in at about 4%, whereas the FTSE 100 was 3.6 or so percent. So just try and look at more than just dividend yield, whether that is across an index or across individual companies. And I just wanted to follow on and share this table because it shows the FTSE 100 yield changing all the time. So you can see back in 2014, it was 3.52%. Then it jumped up to 4.49 in 2019 and then it's gone up and down ever since. So yeah, definitely don't base your decisions on investing just on yield alone. And talking about the FTSE 250 and its performance, it has been really doing well recently. So you can see here this headline says FTSE 250 celebrates best week for 2 years. And we can see that it is up over the last 1 day, over the last 5 days, and over the last 1 month by 12.11%. So it seems to be heading in the right direction, but obviously past performance doesn't indicate future performance. And this, of course, may change. The first FTSE 250 company is Direct Line, and that is an insurance group, one of the UK's largest and leading insurance groups. And I think this stock is interesting because the dividend yield is really, really high. It's 11%, which sometimes is a bit of a worry because you wonder why the company needs to have such a high dividend yield in order to get investors in. And are they covering something up maybe in terms of their balance sheet, debt, anything like that? But they've also managed to increase their dividends every single year since 2012. So you can see from this graph here, they've had an increase. And then in 2019, they cut, but then they've gone back up since. So that is also a kind of a good sign. And with Direct Line, the return on equity is really high and it sits at about 11%. So the return on equity just shows you how good the company is at basically generating returns on the investment it receives from its shareholders. So generally speaking, the higher the ROE, so the return on equity, the better a company is at actually converting its equity into profits. But the interesting thing about Direct Line is that even though they're getting all these profits, they're not really using them at all to grow. So they are using that money to pay this really, really high dividend yield out to its shareholders instead of reinvesting any of it at all. So they're not seeing any growth. And it just seems that they're prioritizing paying this large dividend and increasing it year on year as their main focus, which of course, if you're only concentrating on income as an investor, as a dividend investor, this is a really good thing because you're getting a lot of money. But if you are holding this company for the long term, or you're a bit more interested in the actual growth of the company as well as dividends, it could kind of be a bit of a concern. I do think Direct Line are a really known and trusted company, but I do worry about the competition that's coming up and that they're not really able to handle the changes in market conditions as much, and maybe they're focusing too much on the dividends rather than actually reinvesting into the company and making it a better company. So let me know your thoughts on that one. But just jumping back over to some of the dividend information about Direct Line. It would cost £206.70 roughly to own 100 shares of Direct Line. And by having 100 shares, you would get 2 dividend payments a year, an interim one and a final one, roughly coming in at these figures here. So £7.60 and £15.10. Of course, this will change as the dividend gets increased, but just as a general idea. Just taking a look at Direct Line's performance, over the past 1 month, they're up by 5%, 6 months down by 17.72. Then if we look at year to date, it's a similar picture, down by 27.72. 5 years down again, 42%. And we max it out here, we can see that they're really not seeing that growth. And perhaps that could be because they're prioritizing dividends. So as an investor, you would need to decide whether that sits right with you. The next FTSE 250 company we have is Dunelm. I always go to say Dunelm Mill because that was their old name, but as far as I'm aware, it's just Dunelm now. You'll probably have heard of this company, I'm sure. It's one of the largest UK homeware retailers. And one concern in particular that I have with this company in upcoming times is that, are they going to do well during a possible very, very long recession? Are they going to do well as people perhaps shift how they spend their money and put it into more non-cyclical stocks and away from cyclical stocks like this one? And will this cause a plunge in perhaps the performance and the stock price of this company? That's just some thoughts I have. But if you look at the information about this company, it looks pretty good and it looks pretty healthy. They have a dividend yield of 4%, and you can see that they have been able to increase their dividends pretty much every year for a long time, apart from this one drop here, which is an expected drop given what was going on at the time. So that shows that financially they're pretty stable and it seems quite healthy. So if you were to buy 100 shares of this company, you'd be paying just over £1,000. And from that, you would get 2 dividend payments. And roughly speaking, those would come in at £14 and £26. If we just take a look at how they've been performing recently, over the last 5 days, they're up. 1 month, they're up by nearly 24%. 6 months, up by nearly 16%. Year to date, they're down. But then if we expand to 5 years, we can see as well, they're up by quite a good amount. And when we max it out, at the moment, since September sort of time, up until now, they've had quite a little spurt here, so that's good to see. But my question is, do you think this will carry on? Do you think they're going to keep going up, or are we going to see them drop soon? Let me know your thoughts on that one. Another piece of good news when it comes to Dunelm is that they've increased their dividends to 26p, which again is a really good sign given that they were cut in 2020. And now not only are they paying dividends again, but they're increasing dividends. And it's nice to see this increase. If you compare these final payments to each other and the interim payments to each other, you can see that as time goes on, they are increasing them. So if you're someone that cares a lot about dividend growth investing in particular, this may be one that you want to do a little bit more research into and see if it fits your portfolio. Okay, so the next company is Britvic, who, if you didn't know, are a global soft drinks producer. So some of the brands that they have, you would have 100% heard of. 7-Up, Tango, Robinson's, Fruit Shoot, Gatorade, loads and loads more that I just can't remember off the top of my head. But these are really, really loved brands. I can only talk for me, but personally, I know that I would pay a little bit more for a 7-Up than perhaps a cheaper brand, because there's just something about having that can of 7-Up and knowing that it's really good that I'd be willing to pay for. So I'm sure if that's the case for me, there's lots of other people that would also be willing to pay a little bit more for these really known and loved brands. Britvic seems to be quite a strong company. Its turnover in particular is expected to grow by 13%, and its earnings per share is also expected to rise by over 25%. So these growing fundamentals that we're seeing from this company really help to install some confidence into an investor. I personally don't have this company in my portfolio right now, and I'm not sure I'm going to add it yet, but it's still a really good thing to see, and it does make me want to find out more about this company to see whether it would be a good fit for the future, maybe into my portfolio. This company has a dividend yield of 3.7%, and you can see that they have managed to increase their dividends from 2010, I think actually before 2010 even, all the way up to 2019. Then they took a bit of a hit, as kind of expected, but now they're on the rise again. They haven't yet managed to match the dividends from the pre-pandemic but hopefully they're going to get there soon. And obviously, if they're managing to grow their earnings, then they're probably going to manage to grow their yields over time as well, their dividend yields. So to buy 100 shares of this company, it's going to cost you about £763. And from that, you're going to get 2 dividend payments coming in at about £7.80 for your interim payment, and then the final payment a bit higher at £17.70. This is, of course, based on the figures that I pulled from dividend data, which is not the upcoming year, but the year just gone. So just bear that in mind when looking at these numbers. Over the last 1 month, this company is up by 0.63%. Over the last 6 months, Britvic is down by 11.62%. Let's just take a look at year to date, down again by just over 20%, 20.5%. 5 years down, pretty much breaking even, to be honest. 5 years, it started as it's finishing, if you look at that time period. And then if we max it out, it looks a lot nicer than when you zoom in and look at 1 year, as it always does. The final FTSE 250 company that is on our list today is 3i Infrastructure. Now, I hope I'm saying that right. If it's not pronounced 3i, please let me know in the comments below. But this is an infrastructure investment company investing mainly in Europe and Asia, and they're investing in companies that are providing essential infrastructure. So this gives them somewhat of a pricing power. They have a dividend yield of 3.1%, and we can see again a nice picture of dividend growth. They are growing their dividends year on year. 100 shares in this company is coming in at £337, and again it pays twice a year. A final payment and an interim payment. Looking at 2022, that came in at £5.22 if you owned 100 shares of this company. Over the last 1 month, they are up by 18.63%, 6 months down by 1.27%, 1 year they are down by 9.58%, 5 years is a good picture, up by 42% basically, and if we max it out here, we can see that they've had some real rises, but they've also had some real downfalls as well. Like, if you are a holder of this company, I'm sure you felt really good riding this wave, but it probably didn't feel so nice coming down the other side. Again here, a massive drop. Given the time period, I'm not surprised. A big drop in 2020, again, I'm not surprised. They seem to be going up at the moment though, so I do wonder if that will continue. If you own any of these FTSE 250 companies and you have anything to add, please leave it in the comments below because it might help someone else out there. And if you want to suggest any more FTSE 250 companies for myself to look at or anyone else watching these videos, again, please feel free to leave it in the comments below. Thank you for watching, and I'll see you very shortly in another video.